Welcome back, everybody. Today, we're going to be doing a deep dive into a study, and it's a fascinating one. This study challenges how we think about investing, especially investing in China.
Oh, yeah.
Specifically, we're looking at this concept of momentum investing. And for anyone who's not familiar, it's the idea that stocks that have performed well will just keep performing well. It's like, they have this momentum that just carries them forward.
Yeah, like a snowball effect.
Exactly. And this has been proven right in markets all over the world, but for some reason, it seems to be totally missing in the Chinese market.
Yeah, and this has been a real head scratcher for a lot of financial experts. You see this momentum effect in, like you said, markets globally, but in China, it just doesn't seem to work the same way.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Yeah, so to unpack this mystery, we're diving into a February 2025 paper. It's called Finding the Missing Momentum in China.
Okay.
And this paper was written by researchers at the Shanghai University of Finance and Economics. Now, these researchers, they took a really interesting approach, I think. Instead of just looking at momentum as a whole, they actually broke it down into its different parts. They could see what was driving it or, what might be holding it back.
So it's like they're taking the engine apart to figure out why the car isn't running right?
Exactly. That's a great analogy. And what they actually found was that some of the parts, some of the components of momentum are actually working just fine in China.
Huh.
But there are these other forces that are masking the effects.
So it's not that momentum is totally absent. It's more like it's hidden.
Yeah, it's like it's hiding in plain sight.
Yeah.
And one of the biggest culprits they identified was the behavior of retail investors.
Oh, interesting.
Yeah, so it's possible that everyday investors might actually be the ones throwing a wrench into the whole momentum machine.
How so?
Well, retail investors, we tend to react a lot more strongly to short-term trends and to the ups and downs of market sentiment.
Yeah, we can get a little jumpy sometimes.
Exactly. And all that kind of, it creates a lot of noise and volatility. And that kind of obscures the signals that drive momentum, the more subtle signals.
Yeah, it's like trying to listen to a quiet song in a room full of people talking.
Yes, precisely. And the researchers, they actually found evidence of this in the data.
Oh, really?
Stocks that had high turnover, meaning there was a lot of buying and selling going on, and stocks with high idiosyncratic volatility, meaning their prices jumped around a lot, those stocks showed much weaker momentum. And those are the kinds of stocks that retail investors often flock to.
That makes sense.
So it's like, by trying to ride the momentum wave, retail investors might actually be causing it to crash.
It's like a self-fulfilling prophecy, in a way.
Right. It's a paradox. But okay, so if retail investors are kind of putting the brakes on momentum, who's keeping it alive at all?
Well, that's where institutional investors come in.
Right. The big players.
Exactly. Like pension funds, big investment firms. These guys, they tend to have a much longer-term perspective.
Right. And they don't panic sell at the first sign of trouble.
Right. And they base their decisions on much deeper analysis.
Not just what's hot this week, basically.
Exactly. So they provide a kind of stabilizing force in the market.
It's like they're the steady hand on the wheel while everyone else is swerving all over the road.
That's a great way to put it. And the research actually found that when they looked at stocks that were mostly held by these institutional investors, the momentum effect was a lot more noticeable.
Oh, interesting. So we've got these two groups of investors, retail and institutional, and they're almost like, opposing forces when it comes to momentum in China. But there's another layer to this whole puzzle too, right?
Yeah, there is.
Market sentiment. How optimistic or pessimistic investors are feeling overall.
Right, the mood of the market.
Exactly. So researchers, they found a link between sentiment and momentum, a pretty interesting one.
Yeah, they found that momentum was actually strongest during those periods when investor sentiment was low, when there was a lot of pessimism in the market.
Wow, that's surprising. Why would that be?
Well, think about it. When the market's super optimistic, retail investors are more likely to jump in.
Right. FOMO takes over.
Exactly. And that can kind of amplify all that noise and volatility that we were talking about earlier, you know? That can disrupt the momentum effect.
So it's like too many cooks in the kitchen kind of thing.
Yeah, something like that. But when the market's down, retail investors, they tend to be a lot more cautious.
They're sitting on the sidelines.
Exactly. And that might create a clearer path for momentum to emerge.
Fascinating. So we've laid out the problem. Momentum seems to be missing in China. And we've looked at some of the potential reasons: retail investors, institutional investors, and even the overall mood of the market.
Right.
But the question I really want to get to is, can we actually use this knowledge to build a successful momentum strategy for the Chinese market?
That's a great question. And that's exactly what these researchers set out to do. They designed a special portfolio strategy tailored specifically to the unique dynamics of the Chinese market.
Okay, so let's get to the good stuff. How do they build this Chinese momentum strategy? And more importantly, did it actually work?
Okay, so they called it CHMOM, short for Chinese momentum. And the whole point of it was to try and tap into the specific kinds of momentum that seem to actually work in China.
Got it. So how did they actually build this CHMOM portfolio? Like, what were the secret ingredients?
Okay, so there were two main components. First, they looked at fundamental information.
Fundamental information, so like earnings reports and stuff.
Exactly, yeah, like earnings reports, revenue growth, basically any kind of news or data that would impact a company's financial performance.
Okay, that makes sense. I mean, as an investor, you obviously care about whether companies are, meeting expectations or not.
Right, exactly. The second component they included, they called it residual momentum. It's kind of a fancy way of saying the unpredictable stuff.
Oh, okay.
Yeah, like, those wild cards that make the markets so exciting.
Right.
Residual momentum captures all those things that are hard to predict, like sudden changes in market sentiment, some unexpected news, or even just random price swings that you can't really explain.
Got it. So this CHMOM portfolio is like a mix of the predictable stuff, the fundamentals, with those unpredictable elements that can really, shake things up.
Exactly. It's all about balance, right?
Right. Okay, so tell me, how did this strategy actually perform?
Okay, are you ready for this? When they backtested this strategy, it delivered an average monthly return of 1.16%.
Wait, over 1% per month?
Yeah. And here's the best part. Those returns were still really strong even after they adjusted for risk. So it wasn't just a fluke.
That's incredible. So are you saying that everyone should just drop everything and start using the CHMOM strategy?
Whoa, slow down. We have to remember this is just one study. And what happened in the past doesn't guarantee anything about the future, right?
Right, of course.
Plus, this strategy, it takes some pretty complex analysis to actually put it into practice. It's not just about buying stocks that went up last month.
But you have to know what you're doing.
Exactly. But I think the key takeaway here is that momentum can be a viable strategy in China. You just have to play by a different set of rules.
Right, you can't just import a strategy from another market and expect it to work the same way.
Exactly. You have to adapt to the local context. The Chinese market has its own unique characteristics, and if you want to be successful, you have to understand them.
It's like using a map of New York City to try to navigate London. You'll just end up getting lost.
Exactly. You need the right map for the terrain. This study is really showing that if you understand the unique factors at play in the Chinese market, like the role of retail investors, the influence of those big institutional investors, the impact of the market mood, all of that, you can actually develop strategies that are more likely to work.
So, as investors, we can't just be good with numbers. We have to understand the markets we're investing in.
Yeah, it's like being a market anthropologist or something.
I love that.
You have to understand the culture, the behaviors, the beliefs that are driving the market.
Because ultimately, markets are made up of people, right?
Exactly. And people are complicated. Their actions can create these patterns and opportunities that you might not see if you're not paying close attention.
Right, and those patterns can be totally different from one market to another.
Exactly. So who knows what other hidden momentum opportunities are out there waiting to be discovered? That's what makes investing so interesting.
I agree. Okay, so we've seen how well the CHMOM portfolio can perform, but I'm still curious about the theory behind it. Why does combining fundamental and residual momentum work so well in China?
Right. It all comes down to understanding the dynamics of the Chinese market. Remember how we were talking about retail investors maybe dampening momentum with their short-term thinking? Well, by including those fundamental factors in the strategy, it kind of helps to filter out some of that noise.
So instead of just chasing the latest trends, You're focusing on companies with strong underlying fundamentals.
Exactly, yeah. You're looking for companies with good earnings, strong revenue growth, that sort of thing. That way, you're more likely to find stocks that have momentum that's actually driven by real business performance, not just, hype and speculation.
Right, so it's about finding momentum that's sustainable, not just a flash in the pan.
Precisely. But then there's the other side of the equation, right? The residual momentum part.
Right, the unpredictable stuff.
Yeah, and that's where things get really interesting because the Chinese market, it's still relatively young, it's evolving, and it's known for having these moments of unpredictability.
Yeah, like those sudden policy changes or shifts in sentiment that can really throw things off.
Exactly, exactly. And sometimes it's not even anything that concrete, It could be rumors or speculation that's driving the market.
Oh, wow. So the residual momentum component is almost like acknowledging that these unpredictable events can happen and actually trying to capitalize on them.
Exactly. It's like saying, okay, we know that not everything can be explained by traditional financial models, so let's build that into our strategy.
I like that. It's a more realistic approach. It's accepting that the market doesn't always behave rationally.
Right, exactly. And by incorporating this element of unpredictability, the CH-MOM strategy is better able to adapt to those sudden shifts and maybe even find those hidden opportunities that other strategies might miss.
Like, learning to surf. You have to be able to ride the waves, but you also have to be ready for those unexpected swells that come out of nowhere.
Yeah, that's a great analogy. So the whole approach is about recognizing the limits of those traditional momentum strategies and making them work in the context of the Chinese market.
So the key takeaway here is that context matters, right? What works in one market might not work in another. And if you don't understand the specific environment you're investing in, you're probably going to end up making some costly mistakes.
Absolutely, yeah. This study really highlights the importance of doing your homework. You can't just blindly apply a strategy from another market and expect to get the same results. You have to understand the unique drivers at play in the market you're investing in, things like the behavior of retail investors, the influence of those big institutional players, the overall mood of the market, and how all of those things can impact momentum.
Well, I think this has been a fascinating deep dive into the Chinese momentum puzzle. It's really challenged our assumptions about how momentum works and why it seems to be missing in certain markets.
Yeah, it definitely shows that there's always more to learn, right? And that sometimes the most unexpected places can hold the most interesting opportunities.
Absolutely. So for all our listeners out there, keep an open mind, do your research, and who knows, maybe you'll discover some hidden momentum opportunities of your own. That's all for today, everyone. Thanks for joining us for this deep dive.